Ladies and gentlemen, damas y caballeros, the people said they wanted a video about index investing. And something you learn very quickly in the home video industry is you give the people what they want. The stock market intimidates a lot of people. People think that in order to invest, you need to be some Harvard graduate. And people also think that it's so risky that you're just going to open your account one day and all of your money is going to be gone. But ladies and gentlemen, that is crypto. Investing is actually very simple, and it's not as risky as you think it is. Or let me say it's as risky as you make it out to be. The average person can invest in the stock market without reading any balance sheets or really even know what's going on in the stock market. And in this video, I want to guide you through a very simple, passive form of investing called index investing. I'm going to keep this video as simple as I possibly can, and we're going to go through 5 different steps, starting at what is an index fund and ending at how to buy an index fund. So let's begin by talking about the basics in step 1. What is an index fund? Well, before I explain what an index fund is, let me first explain what a stock is. When you buy a stock, you're buying one single company, like Apple. But when you buy an index fund, on the other hand, you're buying one fund that consists of a group of stocks that tracks a market index like the S&P 500. And in this video, I'm specifically talking about index funds that track the S&P 500. And the S&P 500 is a market index that tracks the top 500 companies in the United States. Now, in case you're confused, let me explain this in extremely simple terms. A stock is one single company. An index fund is one fund that consists of many companies. So instead of buying one single company, you're buying a little bit of everything. You're buying a little bit of Tesla, a little bit of Apple, a little bit of Microsoft. With index funds, you're basically buying the entire market. It's one ticker symbol that represents an extremely diverse portfolio. So that's what index funds are. So now let's move on to the second step and talk about the advantages of index funds. Now, there's no such thing as a risk-free investment. When you put your money in the stock market, sometimes you're going to make money and sometimes you're going to lose money. And when you put your money in crypto, ladies and gentlemen, you lose it all. But compared to buying a stock, there are many advantages to buying index funds. So let's talk about some of these advantages of index investing. The first advantage is it's a lower risk investment. Investing in a single stock can be risky because you're depending on one company's performance. But with index funds based on the S&P 500, you're depending on 500 different companies. And some companies will do good and others will do bad, but it will be the average of those 500 companies. So nothing really crazy is going to happen. You're not going to lose 50% in one single day. It's a much lower risk investment. The second advantage is long-term growth potential. Over time, the stock market returns an average of 10% a year. Now, some years might be better, like 2021, it went up 28%. But other years might be worse, like 2008, it went down 36%. But over time, the average is 10% a year. And if you buy it and you hold it for the long term and you don't sell it when the market is down, there is a lot of long-term growth potential with index investing. Now, the third and final advantage is it's a passive form of investing. Once you buy index funds, your work is done. All you have to do is just let it sit, the market will do its thing, and over time, in the long term, your money should be growing. I mean, it's a completely passive form of investing, but it's a long-term investment. You can't expect big changes in a single day. So those are the 3 advantages: lower risk investment, long-term growth potential, and it's a passive form of investing. Index funds are not a get-rich-quick scheme. The idea is that you're outpacing inflation plus a little more. In 7 to 10 years, you might double your money. You're going to get a much bigger return than just your money sitting in a savings account, although it is important to have an emergency fund in a savings account. And Warren Buffett, one of the greatest investors of all times, recommends that the everyday investor invest in index funds over stocks, and he seems like he knows what he's talking about, ladies and gentlemen. But now that we have a general idea of what index funds are, let's move on to step 3, and that's choosing the right index fund. Now, for obvious reasons, I have to say that I'm not a financial advisor, and this is not financial advice, and I cannot recommend any specific index funds, but these are some of the more popular index funds on the market right now. It might seem overwhelming of which one to choose, but in theory, they should all perform the exact same because they're all designed to track the same market index, the S&P 500. However, there are a few things that make them different, and these are the things that you should consider before choosing an index fund. The first thing to consider is the minimum investment. Some index funds have a minimum amount required in order to invest in that index fund. For example, the Vanguard Index Fund, there is a minimum of $3,000 in order to invest in that index fund. But the Charles Schwab Index Fund, there is no minimum amount required. So depending on how much money you have and how much money you want to invest, that is the first thing you should consider. The second thing you should consider is the expense ratio. The expense ratio is how much money that you're paying every single year in order to use the index fund. For example, the index fund SWPPX has an expense ratio of 0.02%, which means for every $10,000 you have invested, you are paying $2. And ideally, you should keep this as low as you possibly can. A good amount to shoot for is under 0.05%. Now, the third thing that you should consider is transaction fees. Depending on what brokerage you choose, and we'll talk about this in the next step, you could run into a transaction fee. For example, if you buy the Fidelity Index Fund FXAIX on Charles Schwab, you will have to pay a $75 transaction fee. But if you buy the Charles Schwab Index Fund on Charles Schwab, you will not have to pay a transaction fee. So generally, whatever index fund you choose, you should also choose the same broker. For example, if you choose a Vanguard Index Fund, then Vanguard should be your broker. If you choose a Charles Schwab Index Fund, then Charles Schwab should be your broker. And so on. That way you can avoid the transaction fees, and most brokerages now are commission free. Now, the final thing to consider, although it really has no relevance, is called the price per share. Just to avoid confusion, the price per share is how much money you're spending for the index fund. And this has no relevance at all because it's all percentage based. So you're not getting a better deal if the price per share is lower. So those are some 4 things to consider: minimum investment, expense ratio, transaction fees, and price per share. Those are some of the main things to consider. But if you're really concerned, you can always speak to a financial advisor. Some of these brokerages will offer you free services if you need help. But like I said before, they should all perform the exact same because they're all tracking the same market index, the S&P 500. The main thing is keeping the fees and the expenses as low as you possibly can. Now, let's move on to the 4th step, which is getting a brokerage account. So once you decide which index fund that you want to invest with, I know you're probably thinking, Augustine, where do I go and buy some of these index funds? Do I just go to Wall Street and say, $10 of index funds, please? No, please don't do that. Before you can buy anything, you need to open something called a brokerage account. And this is very easy to do. Some of the big name brokers are Vanguard, Fidelity, or what I use, Charles Schwab. And like I said before, ideally, whatever index fund you choose should also be your broker. So if you choose a Vanguard index fund, then Vanguard should be your broker. If you choose a Charles Schwab index fund, then Schwab should be your broker. If you choose a Fidelity index fund, then Fidelity should be your broker. That way you don't run into any transaction fees, which you shouldn't pay for. And pretty much all brokers now are commission free. So you should keep as much money as you can and avoid as many fees as possible. And it's all done online now. It's extremely easy. Just go to their website. They make it incredibly easy. You could probably have it open in 24 hours, but you can't buy anything until you open a brokerage account. Now, let's review what we've done so far. We've talked about what are index funds. We've talked about the advantages of index funds, choosing the right index funds, and getting a brokerage account. So let's now move on to the fifth and final step, which is how to buy index funds. Once you've decided which index fund you want to buy and you've opened up a brokerage account, now you can buy index funds. I personally use Charles Schwab. I am a huge fan of Charles Schwab. They have amazing customer service, and when I was in Peru, I lost all my money. They shipped me a new card in 1 week to Cusco, Peru, and created a customer for life. I'm a huge fan, but don't let me influence your decision. Choose whatever you want. They're all amazing. But I'm going to invest $10, just $10 in index funds. So I'm going to show you how to do that. So let's go to the website now. So here we are in La Oficina de Agustin, where the serious business happens, ladies and gentlemen. And I am going to buy some index funds. And I am not recommending that you buy this specific index fund. This is just to show you how to buy an index fund. And Charles Schwab interface might look different if you go with another broker, but this is just an example. So this is what the interface looks like. If you look, I have $10 that I moved to my brokerage account. And how you get here basically is trade, and then all-in-one trade ticket. So I'm going to buy the ticker symbol SWPPX, which is the one that I buy. And then as you see, it already shows me how many shares I have. And over here, no transaction fee. This is the price as of now, but this will change. So I will click buy, and then I will put $10 in amounts, request order, and it might also ask you to reinvest your dividends and capital gains. I'd choose to do that to avoid taxes. And then all I do is place order and order received. And that is basically all you do. And it's important to know that a stock trades every second. So if you buy a stock, you'll get the price of that second. But an index fund trades once a day. So you will get the price once the market closes at 4 p.m. Eastern Time. And it's really just as easy as that. Once you buy it, your broker should send you an email saying it's being processed, and at the end of the day, you should see it on your account. And now you're an investor. And everyone in America, from the janitor to the wealthy CEO, is now working to make you money. And like I said, index funds are long-term investments. Don't panic if the market is down one day or even 1 year. I mean, the market has done terrible this year. I personally have lost $7,000. But the reality is I haven't lost a single thing because I still have the same amount of shares. And I have faith that over time the market will eventually recover. You're going to hear all these people talking about recessions, talking about market crashes, all these things that Michael Burry is saying, but you just block out all this noise because all they're trying to do is make a quick buck. Over the last 50 years, this is what the market has looked like. There's a quote that goes, "The best time to plant a tree was 30 years ago. The second best time is today." The stock market is an incredible tool to build your wealth over time. In 2023 is a great time to just dip your toes in the water, go at the pace that you're comfortable at, and get the system to start working for you instead of just a bunch of wealthy people that are vacationing in the Hamptons. And with that, muchas gracias, que tenga un buen día, nos vemos, chicos.